Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for October 2020. Well, the end of September marked the close of Q3 2020, with both the Canadian and U.S. stock markets continuing what so far has been labeled a K-shaped recovery. This means simply that some sectors, such as online retail and technology in general, continue to trend higher, while others, such as hospitality and airlines, remain depressed. At the end of Q3 year-to-date, the S&P 500 was sitting positive at 4.9%, while the tech-heavy NASDAQ continued its outperformance, positive 24%. The TSX, Canada's broad-based stock market index, finished the quarter still negative for the year, down 5.52%, but well off of the lows from March. October so far has been choppy for all three of the major indices as investors continue to focus on the U.S. election and new stimulus package hopes, as well as, of course, the development of one or more successful vaccines. First, the U.S. election is a clear source of uncertainty in the near term. The two most likely outcomes the market is currently weighing are whether the Republicans will keep the U.S. Senate or whether the Democrats will take both the House and the Senate. If the Democrats take the Senate, this will likely be supportive of markets. The thinking is that this outcome means more stimulus will come out of Congress and the Democrats should have an easy time passing any legislation they want. While some argue that this scenario will result in inflation, which is a risk for equities, we believe this is not a major problem for three reasons. First, economists were concerned that the massive fiscal stimulus implemented after the financial crisis of 2009 would result in hyperinflation. That never happened. In all the time since the 2009 financial crisis, inflation never became an issue. In fact, since 2009, U.S. inflation has never broken above the Fed's upper limit except for a few months in 2011 when the Fed funds rate remained near zero. Second, there is still a tremendous amount of globalization in the world economy. This means simply that if prices increase within a developed economy, businesses can and likely will look externally to find the same goods and services at a better price. And finally, with the amount of competition that exists globally, it is difficult for businesses to increase prices because competitors can easily come in and undercut those prices. Also, given the amount of detailed information consumers can access about prices, it's unlikely that those consumers will simply pay what's asked of them without searching elsewhere. As far as the current round of COVID-related fiscal and monetary support is concerned, our view is that such stimulus will be more likely to fuel asset prices rather than inflation, which should be supportive for equities. And any stimulus money that does not find its way into assets will end up in the pockets of consumers who will likely spend it. This should add support to corporate profits, which is of course good for corporate share values. The other major economic and market risk with a Democratic sweep is that they may enact policy changes too quickly and aggressively. However, given the current state of the economy, it is more likely that such policies get enacted more gradually and that equity markets should be able to withstand the changes with minimal volatility. Under this set of circumstances, investing in equities would continue to make sense. In the alternate case in which the Republicans keep the U.S. Senate, things get a bit more difficult. A Republican Senate means there would likely be more gridlock and stimulus packages would either take longer to materialize or would end up being smaller than desired. While we believe some form of additional stimulus would result anyway, this prospect of continuing policy gridlock raises the level of uncertainty investors would have to deal with. This would result in additional market volatility initially, but would eventually settle into a new normal. Under this set of circumstances, option premiums would become very attractive and hedging strategies would help protect the portfolio in the near term, after which markets would probably normalize. Regarding the COVID-19 pandemic, we feel the market has already priced in a second and third wave. Having gone through a lockdown and with the support of low interest rates and fiscal stimulus, any uncertainty that arises from these later waves of the pandemic is likely to be a lot less than it was the first time around. In other words, when COVID-19 first hit, investors didn't know how to price in the fundamental changes in the economy. And this uncertainty is what led to the extreme level of market volatility that we observed. However, at this point, with much more known and understood, depending on what market sector you look at, any new information around the pandemic is just as likely to have positive as negative effects. As cases increase in subsequent waves, investors have choices of sectors that will likely benefit even as the rest of the economy drags. Said differently, when the rest of the economy is struggling, investors seek out growth wherever they can find it, often in technology stocks. In terms of valuation, the current price-to-earnings ratio on the S&P 500 is 26.3 times, but the forward PE is 21.6 times. While both are historically high, these valuations are well supported by low interest rates, the U.S. Fed's bond buying program, and additional fiscal stimulus from Congress. Further supporting these higher valuations are accommodative policies that are likely to be in place for a long time. The Fed's dot plot indicates current historically low interest rates won't be going up until at least 2023. As well, the fact that the forward and expected PE ratio is lower than the current PE ratio indicates that there should be EPS growth in the future and that there is good value to invest in. This notion is also supported by earnings trends observed in many S&P 500 companies. Fundamentally speaking, companies continue beating estimates and raising guidance. We are seeing analysts revising their estimates upward, and so the consensus target on the S&P 500 continues to increase. Further, earnings per share estimate revisions are positive and to the upside, which indicates analysts are pricing in future growth. In short, 2021 should be a year of easy comparisons because EPS suffered in 2020, which will be positive for equity markets. All things considered, short-term volatility in the stock market is inevitable based on current headlines. But looking beyond the near-term volatility, we encourage our investors to look past the short-term noise and take a longer-term view. When investors can see the emerging market opportunities and resulting potential for significant gains over the next few years, the near-term crisis and disruptions that created them should be less stressful to deal with. As always, please stay safe and healthy, and on behalf of the Croft Financial Group, thanks for watching.